We're going to be talking today about the everlasting question of, do they ever learn? Now, if you've been paying attention to the markets over the last week or so, you might have seen this man's face pop up. And I want to ask you what this man, Bill Hwang, might have in common with the 2008 financial crisis or Wile E. Coyote Roadrunner. For those of you who don't know the cartoon at the top right, this is a Looney Tunes cartoon that I used to love as a kid. And this coyote would constantly hunt a roadrunner and end up running into brick walls, running off of cliffs, shooting himself in the face, and exploding himself with dynamite. Really good family stuff. The Big Short is a fantastic story, which you should absolutely watch if you can. It's about the financial crisis, a story of financial greed and complacency where big hedge funds and banks screwed over the entire world by over-leveraging themselves. If you're as cynical as me, you might be guessing then that Bill Hwang fits in with this quite nicely. He does, in fact. So who is Bill Hwang? Well, he is a protege of Julian Robertson, who was himself a billionaire hedge fund manager. He retired in the year 2000 and now mostly invests in hedge funds who are run by his old proteges. Bill Hwang was the most successful of those, widely regarded as the most successful, and started his own fund known as Tiger Asia Management. This was started with $25 million of investment from Julian, and he grew it to several billion over the following 8 or so years, when he took a huge hit in the 2008 crisis, as did many other hedge funds at the time. But he bounced back. He continued to show the brilliance that everyone expected of him and continued to grow the fund until 2012, when he was found to be guilty of insider trading. Insider trading, for those of you who don't know, is when people trade shares in companies based on information that's not publicly available. That might be a CEO buying up shares because he knows that the earnings report that's coming out is going to be great, or it might be people in the executive branch selling their shares because they know they're about to be fined for something, or they're about to get a patent rejected by the FDA or something like that. Bill Hwang was fined $44 million for this fraud and was banned from trading in Hong Kong for 4 years, from 2014 to 2018. And big banks no longer wanted to do business with him. So he decided to close up his hedge fund and send back the money to all the investors, and opened Archegos Capital Management as a family office. Now, what is a family office? Well, let's take the family office is quite similar to a hedge fund, but instead of managing lots of wealthy individuals' money, it manages the money of one individual or family. Now, because the expenses of a family office can reach over $1 million a year, the typical minimum for wealth is about 100 million for that family, but it often reaches much higher. We've got individuals like Jeff Bezos and Elon Musk, both with a wealth approaching $200 billion, families that like the Walmart family, the Rockefeller family, who have huge amounts of wealth under management and would like other people to manage it. These family offices, because they are essentially the wealth of private individuals, are much less regulated and less transparent than hedge funds, which provides some sort of attraction to certain people, but is also concerning for those regulators who like to keep an eye on things. Family offices have become a much bigger deal over the last 10 years or so, and now account for about $6 trillion globally. This is very much just an estimate. Because they're much less regulated and less transparent, it's hard to be sure of any details about them, especially on a large scale. So, what happened with Archegos recently? Well, after Bill Hwang had spent many years working his way back into the good books of the banks, he continued to get excellent returns and they were unable to stay away from him because they're suckers for good returns. He was able to perform what's called a total return swap with them. And this is a way of a fund or a family office, in this case, leveraging their money with a bank. We've talked about leveraging money before, and I'm not going to go into the details now of either leveraging or these total return swaps because they're quite complicated financial instruments, but we're going to basically look at roughly how they work. So let's say Archegos has got $10 billion under management, and they go to Deutsche Bank and say, we'd like to use $20 billion of your money to invest in various stocks and real estate or whatever they want to. And they want to do this because that $20 billion will generate them more money than their $10 billion will do. So they would like to use their $10 billion as collateral for that $20 billion. So they say to Deutsche Bank, In return for us being able to use your $20 billion, we'll pay you a fixed interest rate of, let's say, 5%. So in that case, it would be $1 billion. In return, they get to use this money from Deutsche Bank to invest in whatever they want, and they take the return. So let's say it works out well. Archegos uses Deutsche Bank's money to make an investment, and they return $4 billion, which is 20% on the Deutsche Bank money. Archegos owes Deutsche Bank their $1 billion at 5%. They swap them over, and Archegos takes a big paycheck of an actual 40% return on their $10 billion. Deutsche Bank gets their guaranteed interest rate, and everyone's happy. Now, what happens if Archegos' investment goes wrong? Let's say they lose 30%. Well, that's a $6 billion loss. Deutsche Bank is fine because they've got a return swap agreement. They're going to collect the interest rate from Archegos, and they're going to say to Archegos, well, you owe us $6 billion, you're going to take that loss. This would be a pretty big hit for something like Archegos. That would be a 60% loss for them, but they'd be able to manage. Bill Hwang would be out of pocket. He'd be out of pocket $6 billion, but he'd still be a billionaire. I'm not going to lose any sleep over him. Now, this is obviously quite a risky thing to do. Leveraging your money is always risky because although you can maximize your returns, you can also really wipe out your account. So, of course, no one would be stupid enough to go and do this in multiple different places, would they? If you're as cynical as I am, you've already guessed it. Bill Hwang went and leveraged his money at a multitude of different banks. It's very hard, again, because they're not regulated, to be sure exactly how much he was leveraged, but they're estimating about 5 to 1. So that $10 billion was controlling $50 billion in the market, which is risky. It provides good returns, but it means it's much easier to wipe out your money. And that is exactly what happened. Some of his investments went against him, and he suffered what's called a margin call. Now, we talked about this in the presentation on short selling. So if you want a refresher, you can go there. But it's essentially what happens is when a bank has lent you money, and your loss is above your collateral, they will call you up and say, we need you to put up more money to cover your loss. That's all a margin call is. And if you can do it, that's fine. You just give them the more money and they carry on as normal. If you can't cover that extra loss, they start to sell the position to cover it and try and minimize their losses. And this is exactly what happened the other week. Bill Hwang and Archegos Capital Management faced a margin call. Their investments dropped against them, and there was more than the $10 billion of collateral. So the banks had to sell everything, because not only did it wipe out their collateral, but multiple banks had the same agreement, so there was even less to cover. So everyone was trying to scramble and sell everything at a massive discount to reduce their loss. Deutsche Bank actually managed to get away almost scot-free. They did a private deal earlier than the other banks, but places like Credit Suisse, JP Morgan, Nomura Holdings are predicting anywhere from $2 billion to $6 billion in losses each. Now, I've mentioned quite a few times that one of the key things about family offices is that they're less regulated. And what that means is that we were only able to find out about this happening because it had a material impact on the market, and particularly a few stocks that were in Bill Hwang's portfolio. So let's take a look at some of those stocks now. Baidu, we mentioned, is a competitor to Google that works mainly in China, a search engine, and they lost 23% of their price over the 1 week from the 22nd of March to the 26th. Discovery Communications lost 46% of their value. They were trending up nicely from 60 to about 80 and then crashed down to 40. And Viacom CBS lost over half of its price in the market, from about 100 all the way down to 45 or so. And this was due to the banks trying to massively reduce their exposure to these positions. We talked about what happens in one of our first presentations when there's a lot of selling pressure, drives the price down. This is where people have sustained huge losses, and lots of ordinary people who've invested in these companies will also now be facing potential losses due to greed by big corporations and big financial offices. Why are we talking about it? Is it just something that's interesting that's happened, or is it something we should be concerned about? Well, as Andrea Ciccioni says, there is never just one cockroach. So when we saw the financial crisis in 2008, one of the first warning signs people had was 2 hedge funds had to be bailed out by their sponsor, Bear Stearns, who was a big bank at the time, but basically got screwed over by the whole experience. If one person is doing this, What's actually likely happening is that there's multiple family offices who have been taking advantage of the lack of regulation and lack of oversight, and have also been engaging in similar, if not identical, risky financial instruments. They're probably right now being concerned about the idea of greater regulation, and are probably selling off positions trying to get themselves more securely centered. If there is just one person, that's fine, we've already passed it, but there's a potential for a lot of selling pressure in the markets in the coming months as people try to reposition. What do people think about that? Does anyone have any questions? Is any of that unclear?